Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to the final Money Talk of the week, as it's a public holiday here in Hong Kong tomorrow. This podcast is available on Apple Podcasts, Google Podcasts and Spotify. Just look for Peter Lewis's Money Talk in your favourite podcast app, or go to my website, peterlewismoneytalk.substack.com, and follow one of the links there. You can also get in touch with me there. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. It's Thursday the 25th of May, and in today's business and finance headlines, Republican House Speaker Kevin McCarthy said on Wednesday his party's negotiators would return to the White House to try to finish out negotiations on the debt ceiling, but he warned the two sides were still far apart on a number of issues. The two parties have yet to reach a deal to avert a first ever US default, which could occur as early as June the 1st, according to Treasury Secretary Janet Yellen. Minutes from the Fed's FOMC's May meeting showed that increased downside risks in the US economy made its officials less certain about the need to further lift interest rates. Almost all participants commented that downside risks to growth had increased because of the possibility that banking sector developments could lead to further tightening of credit conditions and weigh on economic activity, the minutes said. UK inflation in April saw a smaller decline than the Bank of England had forecast, dashing hopes that the UK Central Bank could soon pause its current cycle of interest rate increases. Consumer price inflation fell to 8.7% last month, down from 10.1% in March, but it missed the Bank of England's forecast of 8.4% and remains well above the central bank's target of 2%. And the core rate, which excludes food and energy, jumped higher to 6.8%. That's the highest since March 1992 and well above forecasts of 6.2%, suggesting there's more underlying inflationary pressure than hoped. President Xi Jinping called Wednesday for China and Russia to deepen trade, economic and energy ties. President Xi met Russian Prime Minister Mikhail Mishustin in Beijing. It was Mr. Mishustin's first visit to China since he became Prime Minister in 2020. Mr. Xi reaffirmed his support for Moscow's core interests and said Beijing was willing to expand new growth points in bilateral cooperation with Russia. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Nitin, Dialdas, Chief Investment Officer at Mandarin Capital. Also with me to discuss the decarbonisation of the Greater Bay Area will be Lawrence Yu, Executive Director at Civic Exchange.
Peter Lewis's Money Talk.
US financial markets faltered Wednesday as policymakers struggled to reach an agreement on raising the debt ceiling. On Wall Street, stocks extended their falls into a fourth day. The S&P 500 lost 0.7% to end at 4,115. The Dow dropped for a fourth straight day, declining 256 points or 0.8% to close at 32,800. The Nasdaq Composite slipped 0.6% lower to settle at 12,484. After the closing bell, shares of chipmaker Nvidia surged more than 25% to an all-time high after booming demand for artificial intelligence processors buoyed its sales forecast well beyond Wall Street expectations. Nvidia said it expected about $11 billion in the current quarter, far surpassing expectations of $7.1 billion in sales. And Nvidia stock is up 109% so far in 2023, mostly driven by optimism stemming from the company's leading position in the market for AI chips. Short-term Treasury yields held near two-decade highs Wednesday as investors fretted over the looming debt ceiling deadline. The yield on Treasury bills that mature in June, around the date the government could run out of money, shot 18 basis points higher to 5.79%, and they did reach as high as 5.88% overnight. The rate's at its highest level in more than 20 years, surpassing levels since before the financial crisis began in 2007. The US dollar index rose 0.4% on Wednesday to its highest level since March the 20th, and the Chinese offshore renminbi fell to the lowest level of 2023 so far as a new COVID-19 variant spreads across China, threatening the country's economic recovery. This morning, offshore yuan is trading at 7.06.5 per US dollar, marking its weakest level since December 2022. Hong Kong's Hang Seng Index tumbled 315 points, or 1.3%, to a more than 2-month low of 19,116 and close to its lowest point of the year. The slide looks set to continue this morning, with futures indicating the Hang Seng will open another 250 points lower. The CSI 300 index of the largest listed companies in Shanghai and Shenzhen erased all of its gains for the year. The index fell 1.4%, leaving it down 0.3% in 2023 so far. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Thursday morning guests. We have with us Andrew Freris, who is the CEO of Ecognosis Advisory. Very good morning to you, Andrew.
Good morning.
And also with us is Nitin Dialdas, who is Chief Investment Officer at Mandarin Capital. Very good morning to you, Nitin.
Good morning.
Let's start with the debt ceiling talks that are going on in the US. Republican House Speaker Kevin McCarthy said his party's negotiators are going to return to the White House to try and finish off the negotiations, but he warned they're still too far apart. Andrew, you've been fairly relaxed so far about this. Markets also have been reasonably calm, although they are showing signs now of getting more nervous about what's going on. Are you getting more nervous?
Not in the slightest, actually. I'm completely soporific, not only because I have seen this happening too many times in my long career. Actually, since 2000, there have been 8 times of a cliffhanger, and all it's eventually sorted out. And also, Peter, it is just a lie that the US government has never closed. I can think since the year 2000, possibly going back a little bit to 1990, of 3 occasions where actually they locked up the national parks, they locked up the state, the sort of, I will call it Ministry of Agriculture. They locked up Ministry of Trade. They locked up the Foreign Department, except Defense, for a few days. But they actually literally locked them up. If you rang on the door, they will not open it. So closing the U.S. government is a very, let's say, theatrical movement. The rest of it is finding enough money to pay interest on the short-term debt. That also has happened in the past. Suddenly, some money was found because, and I'll finish now, because default means 2 things. It means I don't pay capital. I don't repay capital. I don't pay monthly or yearly or whatever it is, interest payment, or I do both. So it takes quite a bit of an effort to do both.
There isn't going to be a debt default on June the 1st, though, is there? Because what will happen is, as you just gave the example, the US government will do other things first to save money, like closing the national parks, maybe not paying social security benefits before they actually default.
Exactly. And what Yellen rather mischievously is not pointing out is money has been found in the past. In other words, Peter, what I'm saying is I've seen this movie again and again and again in the past. And it is really immature for them to be doing this. Incidentally, the ratings of the United States, now I'm sticking my neck out, if I remember well, they were cut in the past. And really nothing happened.
Yep, they were, weren't they? I think it was in 2011, S&P and the other agencies cut the US debt rating down from its AAA grade.
So it isn't that I know better. I'm so cool, calm, and collected that nothing flashes me or flashes me. It is an old movie replayed. Shame on them.
Nitin, are you cool, calm, and collected about this?
Yeah, I agree with Andrew, but I mean, I think we've also got to be a little bit careful because it's always the same story until it's not. And one thing that I was thinking about actually is that this is the first time when we've really seen such bipartisan polls being stuck to the ground. And, you know, you've got massive divides between the Democrats and the Republicans, and they don't want to shift. And normally, you know, there's you always see them concede a little ground here and there and all this. But I think since the Trump era, it's become very, very much, this is our side, that's your side, and we're not going to cross over. No matter what the other side does, it's good as the other side might propose. So that's my one caution, but like Andrew said, we've seen this plenty of times before.
But why this is different this time is because you're really saying there are some extremists in Congress who are happy to go and breach that debt ceiling if necessary if they don't get their way.
Yeah, and that's where the caution comes in. 100%. It's very much that. How extreme are you going to go? But at the same time, I think all of them are nationalists above everything. So I don't think they want to see their country default. And you close a few parks to start with. You close, Ministry of Finance. You close everything until you get to the Ministry of Defence. But how much is that going to annoy your citizens? Because that's also going to play a part in who you're going to vote for, who the blame lies, or where will the blame go? Will it go to the Democrat and the president's side, or will it go to Kevin McCarthy and the Republican side? We don't know that. And both sides will be spinning their rhetoric to blame the other side. We know that is for sure. So I think there's also a risk in terms of letting it default, because then you're just throwing a dart at a dartboard in terms of which side the population comes down on. But I do think, come maybe May 31st, even on June 1st itself, there will be an agreement.
Andrew, there is a real economic cost.
It is also interesting to observe the complete stiff upper lip coming out of Japan and China, which are two of the major foreign holders of U.S. government debt, and they will be the first in line, in inverted commas, if it defaults. And also because the US dollar carries on strengthening. Hello? It does? Yes, it does. Well, it shouldn't.
Yeah, it's
on the back of the fact that the Treasury yields are rising, and the fact that potentially you could default, right? So you need to be compensated for that. So it's kind of an interesting play on that. And with China and Japan, I wonder which side China actually... Do they care more about their debt, or do they actually think this is going to weaken US and that's going to strengthen their position? So I wonder which side they're trying to play.
Yeah, but this will be, Nitin, this will be a classical example of shooting yourself in the foot in order to hurt your opponent. I don't think the Chinese for one moment are sitting there thinking, oh, goody, we're going to lose millions in defaulted payments. And that will teach the United States a good lesson. No, you won't.
Especially when their economy is in the state it is at the moment. I don't think they can afford it. But yeah, you never know. Who knows how these guys think at the moment.
And Andrew, there is a real economic cost to this, isn't there, for the United States, because interest rates are rising. We're seeing, on very short-term debt that expires around this time. They've shot up to 2-decade highs. So, Andrew, there is a real economic cost, isn't there, because interest rates are going up on bond yields are going up. It's increasing the cost of funding for companies. There is a real cost to this.
Yeah, but that will all, once they have set the ceiling, all this is going to collapse back. I wouldn't say to normal. It will take out all the excess of risk. So again, if it increased the cost of funding for 1 month, I don't think we're all going to die.
Nitin, the markets, they've been fairly sort of sanguine so far, although you have seen bond yields going up. We are seeing the dollar strengthening, but stocks are starting to get nervous as well now. Are we starting to see the beginnings of maybe a major market reaction to this?
I think it's... You say major reaction. I mean, the Dow was down 0.4, 0.5%. Nasdaq was down 0.5%. So it wasn't exactly like a massive sell-off, and we haven't seen any massive sell-off go on. So from that perspective, I don't think the market's being unreasonable in the sense they're trading cautiously, but I don't think they're in panic mode yet. Maybe if we get to next week and the deadline is right there, and we still haven't reached an agreement, you might start seeing some panic. But at the moment, I think, like Andrew said, and everyone's kind of tired of the same story. It's a bit like Hollywood. There's no creativity. Even the way they're doing this, there's no creativity. It's the same story that's being played out to the T.
Andrew, in the markets, it's normally when you have sort of political crises like these or economic issues, starts to show up first in the currency, in the bond markets, which is pretty well what we're seeing, isn't it? We have seen bond yields moving up. We're seeing the US dollar now strengthen as well, and now stocks are starting to play catch up maybe a little bit.
The answer is yes, we have seen all that. And the same way, actually, if I cast back of what actually happened in cliffhanger events in United States, I really don't recall a market crash. In other words, something that will see the Dow go down, 4 or 5% on a single day. So, as Nitin said, yes, trading cautiously. What a lovely word. I like to trade uncautiously one of those days.
That's how I trade.
That's getting back to 1999, right? When everything just went crazy.
Yeah. Now, minutes from the Federal Open Market Committee's May meeting showed that increased downside risks in the US economy made its officials less certain about the need to further lift interest rates. Almost all participants commented that downside risks to growth and upside risks to unemployment have increased because of the possibility that banking sector developments could lead to further tightening of credit conditions and weigh on economic activity. The thing is, Nitin, though, despite these minutes, the Fed is rather divided, isn't it? Because we've got some now saying that, including Jay Powell, that we maybe need to pause and assess where things are. But then you have got other hawkish Fed commentators like Neil Kashkari, for the Minneapolis Fed president. He's saying that interest rates are going to go north of 6%. So where do you fit in this?
I think the banking sector is going to win out in that sense. So I think it will be a wait-and-see approach, so I don't think we'll see rate rises in the near term. Obviously, if they can't get inflation back down, then at some point they might need to raise a little bit again. But I think at the moment, what you're seeing in the regional banks, it just means that and in terms of the fact that the unemployment numbers are starting to creep slightly up, I think both of those factors are going to play into the Fed's hands, and they're just going to just wait and see. They've always been accused of doing too much, so I think now they probably will just want to wait and see it. And at this level, I think it's pretty much a fair level for where we are at the moment.
Andrew, where do you stand? You've been leaning on the side of further rate hikes, haven't you?
100%.
And do you still think that?
Yeah, very much so. And actually, I simply base that on what the Fed tells us, not what I think. Okay, inflation is 5%. Okay, target inflation is 2%. Hello, 2%. The Fed has been completely silent. What is the trade-off between every 25 basis points increase in interest rates versus inflation falling? Possibly because they don't know what it is. Well, okay, here we are. I don't know either, but I made a very simple calculation. Really, long-term real interest rates roughly equal GDP growth. Remember, this is all Mickey Mouse economics, but it is a little bit better than what we're getting out of the Fed. So if real interest rates is going to go up to 2%, then right now, with the inflation at 5%, then interest rates should go up another extra 200 basis points to give us a real interest rate of 2%. So if somebody was to ask me how far it will still go, I will say ceteris paribus. Remember that? Everything else remaining the same, which it never does. Okay, then interest rates could easily go up another 200 basis points.
But given that we don't know how much each 25 basis points increase is sort of hitting inflation, would it make sense now to pause for a little bit and assess what the hit has been to the economy, maybe for 1 or 2 months and before?
Well, we have been told that it might take up to 6 months for increases in interest rates to percolate through. Well, the Fed has increased by 500 basis points. Inflation did come down from 8 to 5. So, well, there you go. We have an extra 300 basis points that it came down, but that was over a year period, and it seems now stuck at the 5% level. So I'm clearing my throat, and I will stick to my point. I will say, yes, interest rates will increase, not can increase, will increase. And by how much? I said on the basis of my very simplistic estimates, another 200 basis points.
Nitin, do you think a pause would make sense?
Yeah, as I said earlier, I think a pause... I'm on the other side this time, Andrew, sorry. I think a pause makes sense. And I think Andrew's right in the sense we're still running at 5% inflation, but it has come down from 8%. And 8% wasn't... it was towards the end of last year as well when it was running about 8%. So over the last, say, 5-6 months, it has come down 300 basis points. We're starting to see that trickle through. And I think as you go forward, because you're coming from a higher price base, that inflation number should continue to decrease. Now, what it decreases down to, that's what we've got to figure out. But say it goes down to 3.5%, we're only half a percent off what the Fed target rate would be. So I think at this point it's probably worth just taking a step back, maybe for the next 2 meetings, just have a look, see what's happening in terms of inflation, and then if it's still running high, it's still running at these 5.5%, 6% levels, fine, increase then. But at the moment, I think with the way the regional banks are performing, you also have to look at that side of it. I'm not talking about markets. I know the Fed doesn't care what's going on in the markets, as in the stock markets, but I think they do care what's going on with regional banks and what's going on in terms of employment numbers. And with those starting to either flatten out or regional banks being in quite big trouble, they have to take a little bit of a break and make sure that those stabilise as well.
Andrew, I want to ask you about the UK. Inflation there, it did come down. It hit 10.1% in March. It's at 8.7% now. Still, though, higher than what the Bank of England was forecasting, well above its 2% target. I mean, it's still shockingly high, isn't it, in the UK, when you consider inflation's more than twice what it is in the US. It's much higher than what it is in the Eurozone. This leaves the Bank of England in quite a big hole, doesn't it?
Yeah, no, it's interesting part also. For a change, I saw something that I thought it was sarcastically apposite. People said, well, core inflation went up from 6.2 to 6.8%, and that's bad news. Okay, and that is excluding little non-necessities, such as food and oil. I know. You want to see only the sticky part and not the volatile part. But it is a little bit sad. Okay. Yes, I reckon they may. Invariably they will have to increase interest rates, and the pause is. I don't see the pause there. Mind you, they have all done the usual thing. They went from 0 to 4.5% in 11 moves. So to some extent matches, in inverted commas, what the Fed has done roughly. Mm-hmm. Okay, 10 moves from 0 to 5%. So not that they imitate the Fed by all means, because the sterling is not pegged to the US dollar, but it says that. So a long mumbling reply. Yes, it doesn't look good, and yes, increases in interest rates are very much in the cards.
I'm always amused by statisticians who calculate inflation rates, who then go on to say, if we actually leave out the things that are going up, there's no inflation. And they do seem to have a habit of doing that, don't they?
Yeah, Peter, I did my PhD on the Soviet Union, so I was an expert in Soviet economics. And the Russians at the time also had their own joke. He says, all in all, seasonally adjusted, February was a cold month. In Russia, seasonally adjusted February.
I'd love to be a statistician in another life, I think. It's a fun job.
Oh, yes, actually, Peter, sorry, I'm taking this a little bit of time, but the first thing that I will do is to start quoting quarter on quarter annualized to anybody that will hear, because it is the most meaningless artifact ever. Okay, and I won't tell you what I will do with economists when they come to buy a used car from me. Okay.
You'll end up giving it away. Nitin, this core rate though in the UK, it's a problem, isn't it? It's going up. It just shows that underlying inflationary pressures are increasing. It's becoming more and more embedded in the economy.
Yeah, very much so. And this is a place where I do think interest rates do need to continue to rise, just based on the fact that inflation rates remain extremely high. And maybe part of it's due to currency weakness, but there is serious issues over there in terms of inflation, and it's hurting a lot of people. Obviously, I've got a lot of family in the UK, and the numbers that they tell you, like what they're paying compared to what they were a year ago, I think it's actually worse than 8.7%. And I'll give you an example. Like from my brother, he'll tell me his coffee that used to cost him £6 is now costing him £12. That's 100% inflation. That's not 8.7%. Mm-hmm. His energy bill's gone up 300%.
I will add to that. I have a flat in the UK, and the energy bills are absolutely astronomical, and we use it very carefully, and we're very careful at what we do, and they have easily doubled.
Yeah, no, it's 300%. Energy bills are up 300%. So it's where they're getting the 8.7. It's like I want to know what the stuff that's going down is to get you back to the 8.7.
Well, that's the thing, isn't it? They take out the things that go up in the calculations.
Yeah, of course. Yeah.
Energy. Nobody needs to eat and nobody needs to stay warm. So it's fine. But yeah, I think to answer your question, they do need to raise interest rates, and I think they need to be a lot more aggressive than they have been. Again, it may not be a political winner, but you've got to do that because you've got to start getting inflation under control over there.
I want to ask you both about a couple of movements, interesting movements that are going on in the financial markets. We talked a bit about some of them earlier. First of all, the dollar, it's hit its highest level since March, but as part of that, the offshore renminbi, it's now at its lowest level of the year, has fallen to about 7.06.5 against the US dollar in offshore markets. That's its weakest level since December 2022. Andrew, this has some implications, doesn't it, for policy on the mainland? And I imagine that the PBOC is watching this very closely.
Yeah, well, there are two things to observe here. Let's not forget that the PBOC has actually been cutting interest rates, again, with Japan. I love that. Two of the major, most important central banks in the world are doing exactly the opposite of what the Fed and the European Central Bank are doing. They are cutting, or at least they are not increasing interest rates, so the differentials have been working against the renminbi. And the second point is very quietly, they don't mind seeing weakening, given that the exports took quite a beating. And also very quietly, actually, and there has not been a great deal of comment on that, there has been very steep declines in foreign exchange reserves in China, with some recovery, but not recovery yet to its peak. So yes, I think the PBOC doesn't mind seeing the yen weaken.
Nitin,
sorry, the renminbi weaken,
yeah. Nitin, what do you think? Does this cause a few problems for policymakers? They want to sort of ease policy, don't they, to try and deal with the weakening economy. Does this complicate matters for them?
I don't think so. Again, I'm on Andrew's side. I think over here, if you look at the export markets, they've been weak. So a weak yuan, I've just done the same mistake with the yen. A weak yuan actually helps China on that basis. And they do need to start stimulating their economy in some way. You can't just rely on, domestic consumption when you've got massive youth unemployment, you've got a declining population, you've got, exports declining. There's a whole number of factors over there that they've got to sort out. And I think it starts with trying to bring in money, and bringing in money means that you've got to start manufacturing and exporting to the world again. How they do that, that's anyone's guess, because I think once it moves, it's moved. So you've got to figure out new industries that you can start, creating to export from. But, obviously the weak yuan does help in that factor. I mean, on that basis, in the sense it makes things cheaper for people overseas to buy from them.
Now, the other thing that I wanted to talk about was in the metals markets. There's some interesting moves there. Copper fallen below $8,000 a tonne for the first time since November last year. And also other industrial metals as well are down. Zinc dropped almost 3%, and it's at its lowest level in nearly 3 years. Nickel and aluminium are at their lowest level since September and October, respectively. Andrew, Dr. Copper, the metal with a PhD in economics, is this signalling something to us about global demand, and particularly the state of demand on the mainland?
Yeah, but again, this is no PhD in Nobel Prize economics, because copper is used primarily in two areas. It's used in construction, because pipes are made out of copper, and of course, all the electrical wiring in construction is made out of copper. So construction, strangely enough, is not just cement and bricks that it demands. It demands a great deal of copper. Right across the world has been taking quite a bit, and particularly in China. And then the copper is being used in form of alloys in other things, not so much in car building or in small electrical goods. But then, yes, okay, it reflects definitely what's happening in China, and quite potentially what's happening in the United States, and also the pulse is construction.
Nitin, should we be taking something from this? I mean, copper's down now over 7% on the month. Is it an indicator of demand on the mainland, as some people are saying, and that maybe people are getting quite gloomy about the economy on the mainland? Is this a reflection of that?
Yeah, I mean, copper actually, I believe, has always been thought of as the barometer of what's going on in the world economy, not just the mainland economy. So the fact it's falling suggests there's global issues. China obviously is probably the biggest factor, and like I said just in the answer in the question before, there's a lot of problems going on in China that they need to sort out from an economic basis. And this just is another sign another sign showing what the issues are. But I think it's more broad than just China. I think there is global issues obviously there is talk of recession in the States, whether it's, going to be a large recession, a small recession, but I think most people are in consensus there will be some sort of recession. So I think both factors, China and US are coming into play here, and you're just seeing it reflected in the copper prices.
Okay, well, thank you both very much. You heard the Nitin Dialdas, who is Chief Investment Officer at Mandarin Capital, Andrew Freris, who is the CEO of Ecognosis Advisory. I'm joined now by Lawrence Yu, who is Executive Director at Civic Exchange. Morning, Lawrence.
Morning, Peter.
Now, when we've spoken before, we've talked quite a bit about what's going on the mainland. We were just talking about the weak renminbi and that a reflection of the mainland economy. What are you seeing there?
So, for this perspective, I think actually China is trying to restructuring the economy at this moment. Maybe I can give you example in the Greater Bay Area is even under the trade conflicts, the energy consumption of the petrochemical and chemical industry has even go by like 30% from like 2050 to 2020. And then it's expected to go further increase over the next few decades because they really articulate that the manufacturing industry is a key growth area for the Greater Bay Area. And then currently the Greater Bay, the petrochemical industry consume about like 18% of total energy used in Guangdong in 2020, and it is the number one sector for energy use. Mm-hmm. And then in the next couple of years, there are like at least 5 large petrochemical bases will in operation in the Guangdong.
So where does this leave us then? Because obviously your organisation, Civic Exchange, is very focused on achieving our carbon neutrality goals. And I know you lobby the government a lot. You issue a lot of reports on this. Where are we on the road to attaining carbon neutrality in Hong Kong and the Greater Bay Area before 2050, which is the target, isn't it? That is the government's target.
Yeah, actually the target in Hong Kong and the GBA is slightly different. Hong Kong is 10 years ahead than the national target. In the mainland, they use the 30-60 target. 30 is mean for 2030 to reach the carbon peak, and then 2060 to reach the carbon neutrality. But actually, when we analyze the energy consumption structure in Hong Kong, it's quite similar like in GBA, because Hong Kong and GBA is the energy, the power sector is account for like 74%, around 70% of total emission. And then in the future, actually, we also observe that the major reduction area for Hong Kong and the Greater Bay Area are from the power sector.
And are we on? So where are we in terms of getting to those targets? Are we on track or are we way off course?
So that I can say that actually the good news is Hong Kong and GBA are quite on track on our target. But the problem is because the Guangdong province already decided to develop the new industry like the petrochemical. So that the bad news is in 2060, there are around like 355 million ton of emission that we need to find another way to.
So this is extra.
It.
This is extra on top of what was being calculated before that we've got to deal with. So it's going to put the whole Greater Bay Area definitely off track, then, isn't it, in terms of achieving those goals by 2060?
Yeah. So that we definitely need to identify an option. That's why in the latest research that a joint collaboration between Civic Exchange and the World Resources Institute, and then we identify that if the GBA want to achieve the carbon neutrality goal by 2050, like what Hong Kong is doing now, every year the annual emission reduction should be around 16%, 16%. That is a massive reduction.
So then that means we've got to find new ways, other ways of achieving those reductions. So let's explore a couple of them. If you look at Hong Kong and Shenzhen, densely built up areas, the largest source of greenhouse gas emissions surely comes from all the buildings that we have. So what can we do there to try and reduce all the emissions that are coming from those buildings and make those buildings more environmentally friendly?
So this is a very good question. And then actually a lot of people already think about any kind of technology or IoT technology can really help us. But the problem is everything costs you money. You need, at the old day is the asset owner need to pay the investment from their pocket. But actually Hong Kong is a very great financing hub. We definitely can think about more innovative green and sustainable finance innovation to help us to pay around like US 1.84 trillion investment gap from now to 2060.
1.84 trillion investment gap.
Yeah, that is huge.
That's huge.
Yeah, it's around 1% of current native GDP from now to 2060.
So you mentioned technology. There must be a better way of using technology. I mean, I would have thought we could use things like mobile apps like Alexa and Google so that you can look at your buildings, so that building managers, shop owners, for example, restaurants, can get more information about the actual buildings that they're using and sort of optimize better sort of the energy management, if you like, the energy efficiency of those buildings. That technology is there now, isn't it? So we must be able to use it.
Yeah, and then the advantage of adopting technology is you can help yourself to create a credibility, and then also help the bank to identify your action, your decision. Is this a good decision? And then you can get a cheaper money, and then to help you to improve your energy efficiency. At the meantime, is to help the bank to avoid like critique by some organization, they are greenwashing their business. So that if we can create like a GBA database, and then that can super helpful for like the bank, FI, and then also the asset owner to collaborate together and then pay the externality.
I mean, and if you look at Hong Kong, we've got something like 20,000 restaurants in Hong Kong. Some of them are small restaurants, but there must be ways, because even if you just turn your air conditioning down a couple of degrees, you can save 10% on your electricity consumption, your energy consumption. So using the technology to help people do that, surely those are the things that are going to make the big difference, aren't they, overall, in terms of meeting our targets?
Yeah, definitely. However, is like what you say is around 10%. Is no one really know exact number, the effectiveness of the technology. That's why also people is so hesitate to invest on the technology. But in the future, if we can set up a more scientific guidance for different sector, like the energy sector, and then also the transport sector, and then also for like the restaurant, different commercial sector, that will help them to really understand the impact of their investment. And because one thing is like we cannot manage what we don't measure. So that is like if we can really measure it, create an evidence base, and then that can really helpful for people to create their own transition plan.
Now you mentioned the cost of the transition for the Greater Bay Area to carbon neutrality. You said, I think, $1.8 trillion between 2020 to 2060. That's the period that they've got to get there. How is that going to be financed?
Actually, we can consider this is a huge investment opportunity, because this can really like help the bank and FI to find and figure out their new business through the transition to zero carbon in the future. And then if we can really like develop some transition relays that financial toolbox, that will really definitely can scale up and accelerate the transition in that area. And then eventually is once we create good reputation, and then other China mainland city or like the city in the Southeast Asia will come Hong Kong and then identify the funding source, and then fundraising here, and then we vitalize our FI and banking industry.
I mean, it must be a good opportunity because investors, customers, consumers are becoming more and more interested in ESG, that it's an important consideration now for investors in making their investment decisions. And also, you look at the capital markets, you look at stock exchanges, they're concerned about companies' ESG performance, about the performance of particular brands. This must be a good opportunity now to go and raise money from those investors who are interested and are concerned about ESG considerations.
Yeah, definitely. And then also is like Hong Kong can be one very good position to help us to make sure everyone speak the same language. And then I observed that HKEAs and HKMA are try hard to make sure everyone speak same language, and then try also to connect the technical people like the engineer speak same language as like the FI, the banker, and then also the finance analyst to make sure they can really understand what they are doing afterwards, and then that can really drive a collaboration between two really different sectors.
And what's the barriers then to achieving these goals? What are the hurdles we've got to overcome?
So there are a couple hurdles. The first one is we are lack of the scientific guidance for the transition plan. Secondly is we don't have a clear definition what is the transition activities. And then also the third one is we still not sufficient cross-region collaboration.
So how do we overcome this?
So maybe for the first one, the scientific guidance, we definitely can use some like science-based targets or like the TCFD, this kind of tools to really help us to help the corporate to create a transition plan. And then also for the transition activities is, I know that the HKMA, according to their last year's their annual report, they will come out a consultation around the mid of this year to really consult the community about how the Hong Kong Common Ground taxonomy look like. And then the finally is not just the government speak to the Greater Bay Area, the industry also should more active to identify how they can collaborate, speak more with the stakeholder or like the same industry people in the Greater Bay Area, and then they gradually will sort out a solution.
I'm surprised in some ways that we don't have enough of the scientific capabilities that we need, given that Hong Kong wants to be an innovation and technology hub for the region. We have areas like the Science Park, which is full of companies that are ESG friendly. The Science Park itself, I mean, the whole area, isn't it? It's just full of ESG sort of initiatives. So you would think that we will be able to attract that scientific capability that we need.
Definitely we can attract it if we can really set up a more detailed transition pathway for all Hong Kong. Because when you look back to like the climate action plan published by the Environmental Bureau at year 20 and 21, actually for our decarbonisation pathway, we only have 3 points. The first point is year 2020, and the second point is year 2035, and then the final point is 2050. So that this is not sufficient provide guidance for the business sector to really like forecast the future, what is the business environment, and then what is the cost, and then what is the decarbonisation effort they need to plan from now to future, because the plan the energy investment is a very long investment period to build a power plant at least for 10 to 15 years, or like to invest in like to setting up a SBTi target at least cost you for 1 or 2 or 3 years before you really can get the approval. So that is like Hong Kong definitely need to create our own sector pathway to make sure that one key factor in the Common Ground taxonomy, which is the technical screening, able to really well execute in Hong Kong.
Lawrence, thank you very much indeed for coming in this morning.
Thank you so much.
That's Lawrence Liu, who is Executive Director at Civic Exchange. And if you want some more information on some of the topics that we've been talking about today, please take a look at my daily newsletter, which is on peterlewismoneytalk.substack.com. Thank you for listening this morning. There's no Money Talk tomorrow, as it's a holiday here in Hong Kong for the Buddha's birthday. I'll be back on Monday, and joining me then will be Alex Wong, who is Director at Alex KY Wong Asset Management, and Sunil Kashyap, Director of FinMet, with a view from mainland China, is Ben Cavender, Managing Director at the China Market Research Group. Have a great long weekend.
Money Talk